Good afternoon, everyone, and welcome to the IMAP Specialist Series on Investing in Disruption. Today is the second session of the series covering artificial intelligence and machine learning in portfolio management. My name is Rob De Silva. I am Head of Research at SQM Research, and I'll be moderating today's webinar. I have two panelists with me who will be discussing the topic in some detail, and there'll be plenty of time for questions. So I encourage you to please lodge your questions, and I'll show you how in a second. Just quickly to let you know that IMAP have already planned out quite an extensive series of events for the first half of 2022 at the moment. I won't go through them all here, but you can see that there's quite a few things that should be of interest to you over the time. So watch out for notifications of those events over the next little while. How to ask a question? There's a little Q&A button at the bottom of your screen. Feel free to click on that and type in a question anytime you like. The more questions, the better. That will help bring a more fruitful discussion to the process as we go through. So today we are talking about artificial intelligence and big data and its applications in the investing world. Anyone who's seen the Terminator movies would have experienced the glamorized Hollywood version of the concept. We're going to put that aside today and take a look at the on-the-ground reality. I have with me Dr. James Yang from Coolabah Capital and Dr. David Alin from Plato, who are experts in this field. And when I say experts, the list of their credentials and achievements is far too long to read out in a 1-hour webinar. I will introduce them, however. Dr. David Alin is head of short-long strategies at Plato Investment Management. David joined Plato in January 2018. Prior to joining the firm, he worked for JP Morgan Asset Management in London for 15 years. In 2011, David embarked upon a PhD in quantitative finance at Cambridge University, focusing on portfolio construction. In 2013, he successfully launched and managed the JP Morgan Europe Equity Absolute Alpha Market Neutral Fund. Dr. James Yang, junior trader and senior data scientist at Coolabah Capital Investments. James joined Coolabah Capital in 2020 as a data scientist. James previously worked as a quantitative analyst in enterprise risk analytics at Westpac Group, prior to commencing a Doctor of Philosophy in Financial Mathematics at the University of Sydney. He graduated from his PhD in 2020 and currently has 2 papers in the process of submission to academic journals. Please welcome our 2 panelists, and I will now turn over to James to talk on his views on artificial intelligence.
Thanks, Rob, and welcome everybody to this session. Thank you, IMAP, for having me as well. So what I wanted to talk about, I guess, in these next few slides is, firstly, just giving what I think is a view on what I think is artificial intelligence, and hopefully demystifying some of the views that people have on artificial intelligence. And then secondly, just showing how Coolabah uses artificial intelligence in its day-to-day and also in more bespoke projects as well. Next slide, please. So the way I see artificial intelligence is that it's a software tool with the purpose of optimizing some sort of objective. So in the modern era, this naturally translates to obtaining the best prediction possible. And we see that in our day-to-day. For example, when we use Google Maps every day or use Google search engine, Siri, if you have a Tesla, that's all using AI to a very high extent. But But in another way, AI can also be very simple as well. And just to give you an example, and hopefully this helps kind of demystify, what AI actually is I've just mocked up a quick data set, not real, of land size versus house price. That's the chart on the bottom left. And the natural human mind will think, okay, so if I was to predict what is the house price, say, for another house, which is, say, 600 square meters, I would probably take an average of all the prices within that 600 square meter price range. Sorry, land size range. And then if you do that across all land sizes, the common way to think about it is, maybe we should just draw a line of best fit through all these data points. And that's what humans naturally gravitate towards. And that idea about how we think is often reflected in how we conduct AI. So on the right-hand side, I used a simple kind of technique called linear regression, which I'm sure a lot of people have probably heard of. And this essentially is just constructing the line of best fit. And this is often the way a lot of people will use to predict, do simple predictions. And this is an example of an AI tool that could be used. Obviously, this is probably very simple, but this, I think, is the foundation of a lot of ideas in AI. And going on from this example, what has enabled AI in the modern era, I believe, is this shift towards an abundance of data. And data is really one big enabler of us to have a current state of AI today. Next slide, please. Yeah, so in this slide, I want to touch on what I believe are the fundamental ingredients to AI in the modern era. So the first one being data, second, machine learning, third, hardware and software or computing power, and lastly, domain knowledge. So on data, it really is just the advent of big data in the modern era. Like in the last 10 years, like the size of data sets has just exploded exponentially, especially with the advent of the internet. And there has been a huge focus on having quality data, and that's very hugely important, just because of the fact that a lot of these AIs, if you feed it good data, you get good results. But if you feed it garbage data, you can only expect garbage out. So data has become a huge focus, and especially most of our time is spent around this one point of data. And then secondly, machine learning. This is effectively the mathematical models or prediction techniques that are used to enable the AI. So a lot of these techniques have been around for a while, but it's only with data that has enabled these techniques to work properly. And then also that in combination with the ever-evolving technology, so computing power, all of that has let us enabled us to not to use a data science word, but mangle or wrangle these data sets, these really big data sets. And then lastly, I think domain knowledge is something that's always important in this, just understanding the problem and knowing what the intricacies of the area that you're working in. And in the middle of all of this is like the human being. Like this is an important distinction, because AIs don't develop themselves. It's always human beings that are developing AIs, and we input our beliefs into each of these 4 points. Like we make the decisions on how to manipulate the data. We make the decisions on what sort of machine learning techniques to use, and so forth. So I think these are all essential components to AI. Next slide, please. Yeah, so Coolabah Capital is primarily in fixed income. So I just wanted to give a mark to market on where AI is in fixed income. The first point is that electronic platforms are pretty essential in enabling any sort of AI-based algo trading or quantitative trading. And in Australia, this is essentially not present at all. So most over-the-counter credit is not traded electronically. And because of that, you hardly find any sort of algos in this space. And then secondly, price and volume data is very opaque and generally monopolized by Austraclear. So it's not really available to the public, whereas in equities, it's a bit different. The only exception here being ASX-listed hybrid debt, for the fact that it's exchange traded, makes it the data much more rich. And this interestingly can be juxtaposed to the US and European markets, where because of how the clearinghouses work, you can get more timely and transparent pricing and volume data, and they have more mature electronic platforms as well. So I think there was a statistic that came out recently that in Europe, 50% of the flow is actually done through electronic platforms. And we know that a lot of the CDS or credit default swap market is done using, there's a lot of algos in that space. So it behaves a bit more like like on the list, like the listed markets rather than an OTC market. But in general, I think in Australia, we're heading towards that direction where Europe and US are the way US and Europe function. We have the electronic platforms for it. So GuildBroker, MarketAxess, TradeWeb, Bloomberg, but we just need that data to be readily available. And I think Austraclear is working towards that. Next slide, please. So how does AI fit into Coolabah? So firstly, it is in the way we split our investment team. So the investment team is broken into 3 teams. Portfolio management. So we have 6 PMs or traders. And these are every PM or trader comes from a very quantitative background. So either maths, physics, engineering. And then we have our data science team. So 5 dedicated data scientists. And we also have a 7-person credit research team. So the way I like to think about it is data science, they handle all the quantitative AI-based problems. Credit research focuses on the fundamentals of a company, and portfolio management team tries to synthesize these the 2 ideas together to make decisions. So all 3 teams work in sync. And in that sense, so if I go to the diagram below, I think a lot of people will think of fundamental investing in one side of the spectrum and algo or quant trading on the other side of the spectrum, and also fundamental investing being a slower, I guess, trading strategy, whilst quant or algo strategies are faster. And Coolabah lives somewhere in between. So we generally sometimes move to some slower strats, or we move to some faster strats, just depending on our views. And I also want to touch on why we have our dedicated data science team. And I think this is probably not necessarily common in fixed income. It's mainly because we prefer to have the flexibility of creating our own models and not relying on research from banks or models off the shelf. We can develop our own, and we can input our own views. And we can also do it in a much faster and agile way as well. Next slide, please. So I just want to go over a few examples of where we use AI in our day-to-day. So the first one is our bread and butter. So Coolabah, how we generate alpha is by looking at mispricings in bonds, whether it be in bank bonds or state government bonds. So we generally maintain over 30 quant models looking to value each bond. And this is synthesized with the credit research team, who give a overlay on the assessment of the credit quality of a company. And then this is put together by the portfolio management team to make a decision as to whether to put a trade or not. So below, I just showed an image from our, so we maintain an internal dashboard. So this is a screenshot from the internal dashboard, which ranks bonds from most cheap to most expensive. So here I've just selected a Sydney Airport bond, and this looks very cheap. But because models have their own limitations, this is overlaid by the credit research team, who have said Sydney Airport is not a credit we should be looking at. And you can see that in the red dot for Sydney Airport, whereas the green dots are when the credit research team have a go-ahead with a certain company. And also the portfolio management team have their input in this as well, especially in aspects such as liquidity. Next slide, please. And another model that we have developed in the past few years is our own credit AI model. So look at S&P's standalone credit profile, or SACP, of a company, and we do that using the company's financial data. And this was a collaboration between both our credit research and data science teams. Yeah, so and basically this often serves as a catalyst for us to explore a company further in terms of their credit rating, or we might question the current credit rating of given by S&P, for example. And below, just an example of GE. So the red line is our predicted rating, and the blue line is the actual rating from S&P. So you can see from 2017, 2018, we thought it was rated A. S&P thought it was rated AA plus or AA, and it slowly converged to our rating. So we currently have it at BBB, and so BBB minus, and S&P have it at BBB plus. Next slide, please. And the last example I want to give is a bit left of field. So we actually internally had a strong interest in the event risk of a war between, say, China and the US, or China and Taiwan. And I think we spoke to a lot of experts in the area who had a strong sense that there is a high probability of conflict between these countries within the next X many years. So that sparked an interest in, can we build a model which can predict as accurately as possible and as robust as possible the probability of conflict and war between two countries. So we spent a few months on this. We actually have it on our website called predictingwar.com. Here I just showed the probability of an attack between US and Australia. And we look at this quite often, and we use this in our day-to-day just to as an input into some of our pricing models, where it takes on board the risk between two countries, especially when we price foreign bonds. And yeah, that's it from me. Over back to you, Rob.
Okay, great. Thanks, James. That was really interesting. I'm actually going to ask you a question about your war model. That's really fascinating. So let's turn to David to talk about Plato's approach to using big data and AI. Thanks, David.
Thank you, Rob. And thank you everyone for joining the session today, and special thanks to IMAP for being kind enough to host us. So if we just flick onto the first slide, please. I just thought it would be useful to set the scene to say how the investment landscape has really changed so dramatically over the last 20 or probably 30 years. You know, where you had trade latency in the 80s measured in minutes, now it's in milliseconds, where you had the number of financial indices in the 80s was less than 1,000. Now there's over 3 million different indices tracking everything you could possibly imagine. If you think of corporate filings, in the 80s, there were less than 500 a day for the US. Now there's over 5,000 per day. And so if you consider that a typical 10K will run between, I don't know, 120, 150,000 words, very dense documents. It's very clear that the job of the traditional fundamental bottom-up tire-kicking fund manager is very, very challenging. Whereas 30 years ago, the challenge was getting the information in many cases. Now there's almost too much information, avalanche of information. And it's all about how do we make sense of this data to be able to make better predictions, which ultimately, when it boils down to, is what active management is all about. It's all about predicting, you know, which securities, stocks, bonds, what have you, will outperform and which ones will underperform. I quite like this quote down the bottom, that there's been more data created in just the last 2 years than in the entire course of human history before that. So what Plato's real competitive advantage is, with, you know, half the individuals on the team have PhDs in things like mathematics, computing science, and so forth, is the ability to make sense of that avalanche of information. So if we just step onto the next slide, please. I'll just, you know, we don't have much time, but I just thought I'd give you a few sort of interesting examples and ways that we use big data and machine learning techniques to improve investment outcomes. So what we've shown here are the distributions of return on equity across different markets around the world. And if I can just take a second to explain this, what you would anticipate if there was an absence of earnings manipulation, you'd get the nice, smooth bell curves that we all remember from year one university courses. But the very interesting thing here is, in certain markets, certainly some more than others, you see a pronounced kink in those distributions, which we've marked in red, that occurs around the 0 mark. Okay, so what is this telling us? Well, basically what this is direct evidence of is, as senior management are coming into their quarter or annual reporting season, you know, they have a very good read on whether they're likely to print a positive earnings number or a negative earnings number. And obviously the market you know, prefers the former. And the latitude afforded in accounting standards means that they have the ability to show discretion and recognize some revenues a little bit more aggressively, delay the recognition of some expenses, pushing those into a future period. And what that means is that you'll get this kink that we see here, where there's an unusual amount of companies reporting earnings numbers that are just on the right side of 0, and an unusually small number printing numbers just on the left side of 0. You can see in the US that the relationship is relatively smooth, but in certain markets, for example, Indonesia on the bottom right, you can see that there's quite a lot of earnings manipulation going on. And in Australia, yeah, there's quite a lot as well. That's actually a huge opportunity for us, because it means that if we can identify the manipulators, the ones that are playing a bit fast and loose with the accounting standards, that we can take positions in investment teams that are being more conservative and are likely to not disappoint in the future as they're forced to recognise expenses and revenues have been prematurely recognised. So this is an example of the types of things that we will use some quite sophisticated statistical techniques to recognise. On the following slide, I'll show you just one of them. We've actually got 126 red flags that are fully systematized that we analyze 15,000 companies globally each day on the basis of. This here is an example of one of those red flags. It's actually referred to as Benford's Law, and it was discovered by a physicist. And if no one ever points this out to you, you'll probably never notice it. I know, speaking from personal experience, I'd never noticed that this distribution was evident right before my eyes. I'd looked at thousands of sets of financial statements, and this had never occurred to me. So what is this? Well, basically, if a set of financial statements have been arrived at organically in the absence of manipulation, you'll see a particular distribution in the leading digits of the accounts. So what do I mean by leading digits? Well, the revenue line, say it was 9 billion, then the leading digit of revenue is 9. So you look at how common the leading digits for every single line item, all the way down the P&L, all the way down the cash flow, and all the way down the balance sheet. So 300, 400, 500 different line items per company across those 15,000 companies globally. And what you will see is that you might expect that the number of leading digits that are ones is probably going to be similar to the ones that's 5s and 9s, and you might expect there to be no particular pattern. But what this physicist actually demonstrated is that if the numbers have been arrived at organically, naturally, you'll actually get about 30% of the leading digits will be ones, and about 4% of the leading digits will be 9s. Okay, and that's is something that is sort of hard to observe with the naked eye. You need to have quite a bit of all that data, so every financial item globally for any listed company, to be able to recognize these trends. On the left-hand side, you can see that Apple actually conforms quite well to this the theoretically correct distribution of leading digits. The light blue and the dark blue lines line up pretty closely. But in some of the biggest accounting frauds that we've ever seen, so we've got Enron here as an example, we've got India's biggest corporate fraud on the far right hand side, you can see market deviations away from what the distribution of leading digits should look like and what it actually does look like. And so this is one tool in the kit bag of forensic accountants, and they're using this technique and others every day to identify companies that they should look at more closely. So it's an example of how we will use big data to identify potential accounting frauds that could be landmines on the long side of our portfolio, and indeed a very fertile area to look for shorting positions. If we step on to the next slide, which I think is a way we combine big data and machine learning. Okay, so here there's actually 25,000 earnings calls that happen each year that we analyze. And so the earnings calls, as we all know, they happen periodically as an update by management to the market, where they'll begin with a management discussion section, talk about how they've been trading, and that will be typically followed by a Q&A session after that. And asking those questions will be investment managers like ourselves, as well as investors and people from broker and analyst communities, as well as journalists. So it would be humanly impossible. Like, we worked out you'd need a team of about 200 individuals to properly analyze 25,000 earnings calls globally. So it's clear that in this day, you need to heavily utilize technology if you're not going to leave a lot of information and returns on the table. So how we attack this particular problem? Well, we use NLP or natural language processing, which is a technique for taking the unstructured data that is the earnings transcripts, such as we see on the right-hand side here, and derive a sentiment score for that earnings transcript. Okay, so it will allow us to say, oh, the tone of that transcript is very positive, it's very negative, the tone is improving since previous earnings calls and so forth. You know, what was kind of interesting in the course of our analysis is that when you analyze the sentiment of the management and discussion section, that tends to be very pre-canned and scripted, there's actually not much useful information that enables you to forecast the future stock returns. And why is that? Well, those sections tend to be very well scripted, very well rehearsed, and you know, they're almost like politicians these days in terms of you know, not giving too much away. That all of the information really is in the Q&A section, because it's unscripted and they can't just return too readily to their talking points. So that is the key section that we derive sentiment from, and we use that as the key way of divining which companies are likely to outperform or underperform over the next 3 to 6 months. Yeah, so this is you know, something that technology that we're using every single day, and definitely gives us an edge to anticipate which companies are likely to do well in the future. The interesting thing, and I suppose this is something about machine learning in general, and how it is distinctive from earlier statistical techniques like regression, as we spoke about before, is that with machine learning, you provide data, but you don't explicitly code or program what rules or logic that you want the algorithm to follow. So it enables the modeling tool to be highly nonlinear, with interaction with a whole different range of factors, and can pick up on characteristics that are useful that you were pre-specifying what to look at, you could easily miss. So what are a few examples of this? Well, in the course of this research, we found, or the algorithm uncovered, that if managers were speaking a lot in the first person, then that tended to be positive for future stock returns. But if they were speaking a lot in terms of we and our, they're sort of externalizing things from themselves, and performance tended to be weaker on average with those names. Another example, I guess, is that the algorithms uncovered was if the management talking a lot about the environment and the landscape and the economic climate that they're working within, that tends to be quite negative, because they're kind of you know, externalizing things from themselves. So you know, that's really one of the great advantages in the modern machine learning techniques, in that they can capture relationships that you may miss with the naked eye, and makes it quite exciting. So I think I've probably taken more than enough time. So I think the next step is to open up the floor and to go with a bit of Q&A. Thanks, Rob.
Thanks, David. That was great. I learned something very interesting from that, which is Elon Musk's middle name is Reeve, apparently. So you learn something new every day. So let's talk about the whole topic a little more. I want to get a little more distinction between the term machine learning and AI, because to me they seem to be used interchangeably. I'm not sure that they actually are interchangeable. I feel like machine learning is an element of AI, but not necessarily the complete, package. So maybe you can both give a sort of brief comment on that concept, so that people understand the terminology.
Perfect. After you, James.
Thanks, David. Yeah, so I see machine learning as the techniques or the mathematical techniques. For example, as David said, natural language processing, neural networks, all those, which are used to create the predictions. And then AI would be the software or tool that's used. For example, let's just say Tesla. So the self-driving component is the AI, and then what is used to predict where the car should go is, or the techniques used to predict where the car should go is the machine learning. That's my take on it.
Right.
David?
Sure. Yeah, no, like I totally agree. Yeah, machine learning is like just it's a subset of AI. It's a set of algorithms that can be used to create predictions, and they can range from the simple like ridge regression, lasso regression, to the complicated where we're talking about deep learning and so forth.
Yeah. Well, let me take you've got examples in both your presentations that are interesting. So the bread and butter example, James, that you used about identifying cheap and expensive bonds. And David, you're one of the accounting issues and the bell-shaped curve. How would you classify them? Was there machine learning involved in both of those, or was it really just brute force statistical analysis across the data? It probably applies also to your Benford laws analysis as well. Benford's law, sorry.
Yeah. So I guess like both the examples I gave, the Benford's law and the NLP, applications of big data, I would argue. But the former, in terms of the Benford's law and detecting accounting fraud, that's very much in the I wouldn't refer to that as a machine learning algorithm as such. The NLP it absolutely is, where you're taking the NLP and then you're applying neural networks on top of that as a way of making predictions about what stock prices will do. So, two quite different examples.
Yeah. And James, your bread and butter analysis?
Yeah, so when we're looking at pricing bonds, generally, like for example, we might use a version of regression, like ridge regression, for example. And yeah, that's an example of a machine learning technique that's used to predict what the fair value of a bond should be.
Yeah.
And sorry, go on.
Oh no, go on. Sorry, you finish your point.
Yeah, and I think generally you would consume large amounts of data, or whatever data you can available. You try to find factors which you wouldn't have thought of that can be important towards obtaining a fair value. And again, just to make a distinction between machine learning and AI, I think the tool we make to I guess look at these fair values is that AI tool.
Yeah. So you both gave good examples of how you use the technology in terms of security selection and identifying what to put in the portfolio. I wonder if you've got examples or thoughts around their uses for risk management in a portfolio as opposed to security selection.
For us, we are pretty traditional, I think, in the way that we construct portfolios. I suppose that in the sense that we heavily use optimization.
Right.
And what that means is that we take a set of forecast returns across every single stock in our universe. We have a risk model, which is a huge matrix of all of the variances and covariances between all the different assets. And we have transactions costs modeled for each of the individual stocks. Now, like, the modern optimization has been around for a long time, but I actually think it's probably one of the most powerful things in our toolkit, in that it can create a portfolio that you could, we actually, when I was at JP Morgan, we used to actually give this challenge to our new graduates. We said, okay, this is, you can pick any stock you want, any weights across these 350 stocks, but you need to produce a portfolio that has this much expected return, this much risk, satisfies these different constraints. And some people thought I was a bit of a bastard for giving them that challenge, because it's actually, for a human, that's impossible. It is impossible. You could be there a year and you would never be able to. The second that you go, okay, I've increased the alpha, suddenly the risk has popped out, or you're not satisfying this constraint. So, that's an incredibly powerful technique. It probably, like, depending on what optimizer you use, some use genetic algorithms, which are AI based. We don't. But that's an incredibly powerful tool, I think, and can really mark out risk managers, because you can generate high returns, lower risk, lower turnover.
Actually, and it's a good point, because that's a type of quantitative technology that's been around for decades and is continually evolving, etc. But it's an example of, if you want to call it AI, that's been in use traditionally for a long time in investment management, and just continues to evolve and grow over time.
It's actually an example. Like, people are always talking about, AI is about getting computers to think like humans. This is an example of where you can get it to do something a human could never do.
Yeah. James, have you got any comment?
Yeah, I think we're quite similar. So we're pretty traditional in how we use optimization in our portfolio management, in terms of, and in our risk management as well. We also look at traditional VAR models a lot, and all those variants in our risk management. So those have been around for ages. In a way, they work perfectly fine as well, and they give great insights. I mean, we do have like some interest in AI-based like portfolio optimization. That's something we've talked about, and something we might look at, but it's things we're further down the road.
And it's interesting, I think probably your credit rating prediction model is a form of quasi-risk management as well, in the sense that you're trying to get ahead of problems and therefore avoid them through that process. But let me turn the tide a little bit, in terms of, when you look at this, you've got inputs, you've got processing, and you've got outputs. The processing is really the AI kind of element. The input is the big data. And one of the things about the data is, firstly, just the size of it, but secondly, the availability of it, right? And now you're getting big data sets that are not public information. They're selective. You've got to pay for it, especially satellite. People are selling satellite data for all sorts of sources and reasons. So how much of the value in processing and using AI in investment management might come from proprietary data versus public data. Do you have a view on that, or is it still an evolving area?
Yeah, I think it's both. Like one of the alpha models that we built is we said, okay, let's just throw all of the traditional data at there and to say, okay, can we come up with better predictions for how companies are going to outperform than our historical approach, which is more traditional statistical approach. And sure enough, those types of models that they did outperform our traditional models by a little bit. It wasn't a night and day comparison. The thing that always makes me a little bit nervous that the second you go into AI and machine learning, particularly the more advanced techniques like random forest and neural networks, the higher predictive ability comes at the cost in general of it becomes virtually a black box. Okay.
Yeah.
So you've got these inputs going in, and then suddenly it's going, okay, do A, B, and C. And if a client asks me to explain, oh, why is it doing A, B, and C? So an early example, I think it was DARPA were doing they were programming technology to be able to recognize tanks so they could automatically fire. And they were very happy with themselves. It was working incredibly well. And then suddenly they showed them a different set of images that hadn't been in the training data. And it wasn't recognizing a single tank.
Yep.
And they couldn't work out why. And in the end, they worked out that the original pictures, all the tanks, the pictures had been taken where the tanks was on top of grass. And so a very basic thing. But I personally think the best application of machine learning is where machine learning is applied with a human hand on the tiller. Yeah. And that in the same way that I'm very happy that when I jump on an A380 that they've got an autopilot.
Yeah.
I'm even happier that there's a pilot sitting next to them.
Yes. Yeah, which is why there are laws and regulations about being able to take over a self-driving car at the moment. You don't just let them run amok, so to speak.
I think so.
Yeah, just to add to David's point on how if you use more complex machine learning techniques, you often sacrifice interpretability of the outcome. We had the exact same situation with the predicting war model. Like we tried a range of models from the simplest being logistic regression, all the way up to random forests, boosted trees, neural nets. We tried all of that. They provided marginally better results in the predictability, but in the end of the day, like in terms of can I tell you what factors contributed to this probability? It's a lot harder with these complex models. So in the end of the day, we just chose logistic regression, much more simple, gets most of the way there, and just way more interpretable, I think.
Actually, that's a great introduction to my question about your war model. There's a couple, actually. When I had a look at the chart as you put it up, it was the probability of war between the US and Australia, which is an interesting comparison, right? And I note that the peak of that probability was during World War II. So I'm a little confused about that outcome. What kind of data is going into the model, and how did it come to that conclusion around the probability of US and Australia going to war against each other?
I guess a few things. Why I chose those two countries, I guess the most politically insensitive.
Right. Yeah.
And also how it came up with that conclusion, I'll have to dig into that. Actually,
I'm assuming that it's got something to do with just general conditions, more risky and warlike, and that meant that possibly anyone could go to war with anyone almost.
Correct. Yeah. So it's I guess in a way to answer that, I'll just describe a bit of the data set that we used.
Yeah.
Huge data set, I think that's been compiled over, 60, 70 years, called the militarized, I forgot the middle word, but something data set. Militarized interstate data set, widely available and recorded by unis. And we use that has data on like trade, size of military, the expense governments have committed to military,
Right.
bordering countries, alliances, nuclear weapons, the whole lot. And I think during that time, you have a heightened sense of like every country was investing in the military, and all those things. I think that heightened that probability of war between any country, really, I'd guess. I haven't really dug into that US Aussie example, but yeah, that would have been my guess.
Yeah, and it wasn't meant to be critical. It was just an observation. It was interesting to see how that sort of panned out. I'm curious, how many observations of actually military events are you looking at? We all learn in school the big ones: World War I, World War II, Vietnam, Korea. But obviously, it's not just limited to that. So, do you have an idea of how many altogether?
Not off the top of my head. So we actually tiered the conflicts. So we looked at like use of force, use of attack, and then actual war. So different severities. So for example, war would be, full-blown military versus military, whereas like attack could have been seizures of fishing boats. So for those where the data was more available, as in there's definitely more seizures of fishing boats than there are war, then your predictability is a lot better. But yeah, in terms of full-blown war, there's not many. Definitely not many. Yeah. And it makes predicting pretty hard.
Yeah. Let me throw a curveball to you both. If there's one rule about the relentless march of technology, is that the costs come down and the ubiquity of it expands over time. So can you see a day where you can go to your phone or whatever device exists in 10 or 20 years and, using Robinhood or some other app, have AI available and usable in some generally widely available technology? And right now it's linked because it's costly, it's specialized, big data, big processing, etc. Is there a time when all of that will be commoditized and you can do it on your computer or your phone without being, having 5 PhDs as you do between the two of you or whatever it is?
Yeah, unfortunately for us, I guess at least, yeah, definitely. Like, that's just capitalism, isn't it? And I think there are already some poor quality versions that are sort of available. So yeah, and it's a relentless sort of march forward and a bit of an arms race. But yeah, the good thing is, I guess from our perspective, is that AI in isolation, while valuable, can be dangerous. I think you need that combination of man and machine will always be machine in isolation.
I think you made a very good point when you were talking about the tank example. And again, there are other examples in other fields. For example, facial recognition, the early work on that was turned out to be problematic because the programs were trained on, white Anglo-Saxon faces and therefore had huge difficulties recognizing anyone of any other ethnic background. So what was the problem? It wasn't so much the AI itself, but the data that was being fed to it, right? So whenever you have whatever the app might be or whatever the process in the future might be, it's not just the quality of that algorithm, etc., but the way it's been prepared for use, if you like, and that training element of it apparently is very critical. There's lots of very finicky parts to the whole that are important to get right to make the whole work properly. Would that be?
I think so. I think so. Like one interesting thing for me is that the original neural net algorithm was actually devised in, I know this because I Googled it this morning, in 1944. But it was, so far ahead of its time in terms of data and raw computing grunt. It meant that it could never be applied and never really successfully applied for another 50, 60 years to be something that's really, really powerful.
Yeah.
It's kind of a bit like, Da Vinci with his designs for the helicopter 500 years before it came into being. So, yeah, to James's point, it's what's made now the time. It's a confluence of big data. It's a confluence of, with Moore's law and processing speed, cloud computing making it so cheap, as well as some better algorithms have come along as well.
Yeah. So in the world of investing, algorithmic trading, quantitative trading, systematic trading have been around for a few decades as well. And again, always evolving and improving because of the advances of technology. But what comments would you make on what evidence there is about how those types of techniques perform versus the traditional, fundamental investing, non-highly quantitative investing over the years? Have you seen academic studies or have any views around that?
Yeah, I think currently there's a place for both. Those guys live in for the most part, live in super high frequency. They don't care as much about the fundamentals and just care about market flow. And in a lot of ways, it's just made the market more liquid. But of course, with it comes issues of misuse of those algorithms, for example, that bring about flash crashes, all those sorts of things. I think that comes from not understanding the algorithm enough, or algorithm not being able to adapt to idiosyncratic events. And I think that's something that's got to continue in the future. And the way I see these idiosyncratic events, I think that's a place for human beings rather than algorithms.
Actually, Michael Lewis wrote a book on that very topic.
Flash Boys?
Was it Flash Boys, Silicon Boy, whatever it was?
It's
I haven't read it yet, but I'm going to. It's an interesting topic. Here's another one for you. One of the sort of newer advances that are just embryonic, I guess, quantum computing. What do you guys see as the future there? Is it going to be applicable in investing at any time?
Yeah, well, it means that, the models can be more sophisticated because they, one of the, as the data gets larger and larger, the training times become exponentially larger as well. And quantum computing in theory can mean that things that were not possible before, in the same way that neural nets weren't possible 50 years ago, become possible. So yeah, there is a potential interaction there.
Okay, well, I think we've come pretty much through the journey. We're almost at 1 o'clock, so I think it's time to wrap up and say thank you to Dr. David Alin from Plato and Dr. James Yang from Coolabah, who've done a fantastic job in describing it and talking about it. Hopefully it's enlightened yourselves as to some aspects of it you might not have been familiar with. We had some good questions come through. Just noting, we've got one more session on Friday, so please feel free to join us for that one. The topic is, what role will the disruptors and disruptive technology play in portfolio management? And we have experts again from BetaShares, Longwave Capital, and Wealthlander, so it'll be well worth watching if you're able to join us. We appreciate that, and thank you all. Have a good afternoon.
Our pleasure.
Thanks.
Thank you all. Much
Thank you,
appreciated.
everyone.